Okay. Good morning, everyone. So today we have a fresh standard, that is Ind AS 12, income taxes. I hope the previous standard on earnings per share has been fairly clear to everyone. You could do the questions which we had discussed. You could practice. So I will not be doing. I hope there is no much difficulty in that. Okay. So today's session, very practical, something which you have already studied in your winter as well, that dealt with income taxes. There it was AS 22 that dealt with accounting for income taxes. So here it is Ind AS 12 that deals with the similar, what you say, that deals with a similar topic. Only thing is the approach has changed. The approach has changed greatly. So we shall understand what exactly is the difference and how this appears to be an improvised version over AS 22 and what are the new things which is there in Ind AS 12. Okay. So this is part of your module 3 Ind AS 12, that is income taxes. Okay, so with this we quickly start. I have prepared the presentation. I think you got the presentation for Ind AS 33, right? Just confirm that you have received it, because if you haven't, I will ensure that it reaches you. Okay, and yeah, so good morning Viraj, Shailesh, Tariq, and Yadu, good morning. Okay, so I hope, where are the others? Yes, are the others joining in? Yeah, just give me a minute. Um, okay, yeah. So with that, we start the topic, that is Ind AS 12, income taxes. Okay. So now, what used to happen, or what happens is, see, we prepare our profit and loss account, right? We prepare our profit and loss account. In the profit and loss account, we have revenue, we have expenses. So that gives me net profit before tax. Okay, I'm taking a very simplistic example at a very high macro level. Okay, so I'm not exactly going into the nitty-gritties of the schedule 3 format, etc. I'm just going on a very macro level. So you have the NPBT. Now, it so happens that you people are also experts in income tax. Okay, at least that's what I believe. So when you people are experts in income tax, what you do is you take net profit before tax as the starting point. Sir, हम तो net profit after tax लेते हैं and then we add back income tax. बात एक ही है. Okay. So you start with net profit before tax. You are going to add certain items which are what you can say not allowable expenditures under the Income Tax Act. You are also going to add certain items for which a separate deduction could be available. For example, you would be adding back 43B disallowances. Yes, all your what you say statutory dues which you have not paid till the time of filing the return. You add back those statutory dues. Then there could be cases where, suppose you have made a donation towards scientific research, okay, for which a weighted deduction is available. So therefore, you will have scientific research donation. I will add the full expenditure here, and I will claim the weighted average as part of the deductions, right? Then there could be a case where you add back the book depreciation, and you can claim the deduction later. So this is going to be my additions. Okay, just I'm taking it on a very high level. So less 43B allowances, whatever you have paid, 43B deductions. Okay, previous year disallowances, if you have paid it now, you can avail it. Scientific research, the weighted average deduction 1.5 times probably. And you are having depreciation allowed or computed as per the tax laws. So this gives you the deduction and this gives you the taxable income. This gives you the taxable income. On this you apply your tax rate. On this you apply your tax rate and that becomes your tax liability. And this tax liability will go and form part of your provision for tax for the current year. Okay. It forms part of your taxation provision. So this gives you net profit after tax. And this ends your P&L. Okay. So now what I want you to tell me is, is this and this equal? Is my net profit before tax and taxable income equal? Is this equal or is this different? Okay, hi, good morning Shruti, good morning Mohammed, good morning Tanisha, good morning Mansha, good morning. Yes, so is my net profit before tax and the taxable income under the tax laws, is that different or is it the same? Will that be different or will that be the same? Okay, answer quickly. Different, obviously. Sir, वो same कैसे हो सकता है? You started, this is same. This is same. This is my starting point. But abhi you only did so many adjustments now. So therefore, the gap is there between the net profit as per the books and the taxable income as per the income taxes. So this gap arises on account of certain allowances and disallowances under the tax laws. Fair enough? So now the question arises, assume that you have a reader of financial statements, उसको थोड़ा बहुत समझ में आता है, he understands a little bit, okay, he understands a little bit, but the problem is he does not understand much about income taxes. He does not understand much about income taxes. Okay. But he understands a little bit of financial statements. So what that fellow does is probably somebody like me. He's not an expert in income tax, but he understands a little bit of financial reporting. So he looks at the net profit, at the profit and loss account that is presented in the reporting, and then he will look at the net profit before tax figure, and then he will see the tax, and then he will look at what is the tax rate applicable to this entity. Suppose the tax rate applicable to this entity is 30%. Suppose the tax rate applicable is 30%. What will be the first thing that this person does is, he will take net profit before tax, which is appearing in the books. Okay. And when he takes the net profit before tax appearing in the books, he is then going to multiply it by 30%. He is going to multiply it by 30%. You tell me, net profit before tax into 30%. Is it going to be equal to the tax or will it not be equal to the tax? What do you think? A, equal to tax, B, not equal to tax, what is computed? What do you think, A or B? He knows that rate of tax is 30%. So he does net profit before tax into 30% to check whether it will be equal to the tax amount which is provided in the profit and loss account. My question to you is, will net profit before tax into 30% actually be equal to this? Will it be actually equal or will it be different? Okay. सोच के जवाब देना, think and answer. Okay. Okay, right. See, my tax is taxable income into 30%. You have just previously said, sir, these two are not equal. If these two are not equal, then obviously net profit into 30% will not be equal to the tax. And then this person will start scratching his head. He will ask, sir, tax rate is 30%. Your net profit before tax is X. So X into 30% should be equal to tax. But it is not equal to tax. It is something different. Where is the reconciliation? Where is the difference? Where is the gap? And then he will not find an answer to that. He will not find an answer to that. Yes. So therefore, if he is not going to find an answer to that, we have to provide an answer to that. On account of us being financial reporting experts, we have to give an answer in the financial statements. We have to ensure that we convince the reader that, wait, this is why the gap is there. Okay, the net profit before tax, the tax expense, this is the reason for a particular gap. That is what Ind AS 12 seeks to do. That is what is the objective of Ind AS 12. Basically, it is another matching concept. Basically, it is another matching concept. What happens is, let us understand first simple things. Then I will take you through the presentation. Then we will do some couple of questions. By that time, you will be familiar with what is the objective. And then we will delve deeper into the actual provisions of Ind AS 12, where you have deferred tax, this, that, everything is there. Okay. So now the problem is, let us understand. Just zara soch samajh ke. Okay. Just zara soch. That's right. Add and less, advance. Yeah. So the gap arises, as rightly said, that it arises on account of allowances and disallowances. So now some of you may say, sir, if I have to convince the reader of financial statements, then I will also attach my computation as part of the format. मैं अपना computation add कर दूंगा वहां पे. Yes. Is it a practical solution? Answer is no, it's not. Whoever said that your financial statement should include your computation, that is such a what you can say, that is such an awkward thing to put in your financial statements. The computation of income is part of your Income Tax Act. The financial reporting is part of your Companies Act requirements. Why are you putting your computation of income here? You should not put your computation of income. Rather, you should build a bridge. You should build a bridge. Okay. So what is the bridge doing? You have your financial reporting. You have your income tax. Your financial reporting to income tax is connected by a bridge. The name of this bridge is Ind AS 12. The name of this bridge is Ind AS 12. What it seeks to do is, it seeks to give the reader of financial statements an understanding, a reconciliation. The ultimate goal of Ind AS 12 is, it presents a reconciliation between what is the tax rate that the statute has prescribed versus what is the tax rate we are getting, and why do I have the gap in between. That you will be giving an explanation. That is the ultimate goal of Ind AS 12. That is the ultimate goal of Ind AS 12. Now the issue is like this. Let me just explain to you and you will understand this. Okay. I will take a simple case. I'll not complicate things. Okay. You have net profit before tax. Okay. Now, for one of the months, let us assume for the month of March, you did not file the GST returns properly, and therefore the GST liability remained unpaid. Technically, you cannot file April's GST until March is cleared, but let us presume the remaining filings have happened. We are not going into the fiscal loss as such. That is a part of your paper 7 and 8. That is a part of your paper 8 and paper 7. All right. But right now, what we are going to look at is, right now, what we are going to understand is, why do I have this gap? Okay. So let us assume that GST of March is unpaid. Because your GST of March is unpaid, you are going to add back 43B disallowance. 43B disallowance. I hope you remember this unpaid GST. Okay. Whatever be the amount, I am adding the unpaid GST. Okay. So this will be your taxable income. And on this, I multiply 30%. So that gives you your tax liability. My question to you is, answer carefully. Don't jump to any answer. Okay. Net profit before tax into 30%. Let us name it as A. Taxable income into 30%. Let us name it as B. Both of you said it is going to be different. So that I appreciate. Now I'm going one step further. Look at both of them. Look at both of them. Okay. Now, my question to you is, what is going to be greater? Is A greater than B or is B greater than A? Okay, is A greater than B or is B greater than A? That means A will be smaller than B. Okay, you tell me what is the right answer? Is it 1 or is it 2? Based on this understanding. Based on the fact that ओके अभी आवाज आ रही है थोड़ा पावर इश्यू हो गया था हेलो ओके all right there was a small power issue but anyways that is sorted out now okay so my question to you is in this limited example that we have done uh, just a second please just a second. So in this limited example that we have done, what do you guys think that is A greater than B or is B greater than A? Sir, in this case, I started with net profit. I'm adding something to that. That something is the 43B disallowance. That 43B disallowance has increased my taxable income. And because it has increased my taxable income, then this B is obviously going to be greater than A. This B is obviously going to be greater than A. So therefore, option 2 is correct. Now my question to you is, I'm extending it further. My question to you is, you know income tax better than me. My question to you is, will this 43B disallowance, be an allowable expenditure when it gets paid? Will it be an allowable expenditure when it gets paid? Yes, answer is yes. It will be allowable. So suppose this is year 1. Okay. Then I move to year 2. Okay. Now in year 2, I have net profit before tax less 43B allowances, GST of previous year paid. Current year everything is paid, there is no problem. So 43B you will allow it as an expenditure. So this will be your taxable income. And on this, I will multiply 30% to give you the income tax. Now my question to you is same. Net profit before tax into 30%. Taxable income into 30%. Is A greater than B or is B greater than A? Answer me now. In the second year, think and answer. In the second year, is A going to be greater than B or is B going to be greater than A? What do you think? In the second case, is A going to be greater than B or is B going to be greater than A? Think and answer. Right? Think and answer. That's right. So A is greater than B. Absolutely right. You guys are amazing. Okay. So in this case, net profit is higher. I get an expense, an allowance, and therefore my taxable income goes down, which gives rise to a lower tax amount. Now I'll go one step further. Is this increase a permanent increase or is it a temporary increase? Is it a permanent increase or is it a temporary increase? Is it a permanent increase or is it a temporary increase? Temporary. That's right. Okay. Everybody said it is temporary, which is absolutely right. Sir, what is happening is, why are you going so much in circles? Come to the point. Sir, what you added in the first year, you subtracted in the second year. So this is a temporary increase. That means, now let me go one step further and say, you are paying extra tax on this disallowance at the rate of 30%. You are paying an extra tax on this at the rate of 30%. Can I say that this additional tax which you have paid is nothing but an extra tax which you can claim a refund? I'm not saying cash refund. I'm saying that this 30% extra which you have paid is nothing but something which will entitle you to a benefit in the future. Sir, sir, look at this now. In the next year when you pay, that much your tax goes down. That much your tax goes down. So you are paying higher today so that you can save that much amount in the future. Am I clear? Am I clear or not? Am I making some sense to you guys? Yes. I'm paying a higher amount today, because of which I'm going to get a benefit of the same amount in the next year. Now, understand and try to recollect what is the definition of an asset. What is the definition of an asset? Something which gives you monetary benefits in the future. Something which gives you monetary benefits in the future. This something which gives you monetary benefits in the future is the fact that you are prepaying this. You are prepaying the tax of 30% on the disallowance in the first year, and that allowance you will get in the future when you pay it. So can I say that this is nothing but something like a prepaid expense? Can I say that it is something like a prepaid expense? Answer is yes, sir. This is something like a prepaid expense. So therefore, am I the one who controls this prepaid expense? Answer is yes. As long as I pay it, I can claim the deduction. If I don't pay, I'll not claim the deduction. Okay, so therefore it is in my hand. It is in my hand to claim the deduction. And therefore, you are going to have your first year on the disallowance you have paid 30% is nothing but a prepayment of tax for the second year, is nothing but a prepayment of tax in the second year. In the second year, whatever extra you had paid will be available as a set off on account of payment of that GST liability which you had not paid previously. So this is like a prepaid expense, and this prepaid expense we are going to set off. We are going to set off or realize in the second year. And because it is getting realized in the second year, because it is going to be realized in the second year, it is getting postponed. The benefit of this is getting postponed to the second year. If you pay in the third year, it will be allowed in the third year. So postpone to the third year. So basically, we are deferring it. Postponement is used by layman. Okay. You ask a normal BCom graduate and he will say, sir, कुछ भी delay हो गया, हम postpone कर देंगे उसको. We call it as postponement. थोड़ा सा BCom honors category student, he will call it as procrastination. But you guys are the cream of this society. So therefore, हम उसको postponement नहीं बोलेंगे. We'll not call it as postponement or procrastination. We give it a new word. That new word is called as deferred. That new word is called as deferred, something which you already know. I am deferring this. I am postponing it. I am claiming the benefit of this in the later years. So we are deferring it. तो उसको बोलते हैं deferred. This is related to a tax and we call it therefore a deferred tax. And this is giving rise to a reduced liability in the future. So therefore it becomes a deferred tax asset. Therefore it becomes a deferred tax asset. So my whole Ind AS 12 talks about two concepts. One is your current tax. The other is your deferred tax. One is your current tax. The other is your deferred tax. Okay. So now when I talk about my current tax, sir, what is current tax? Current tax is nothing but the taxable income or the income computed in accordance with the tax laws multiplied by the tax rate. That becomes your current tax. That becomes your current tax. So that definitely goes and sits as part of your tax expense. But there is something extra which goes and sits there. That something extra is known as your deferred tax. Something that we just now saw. Something that we just now saw. Are we clear with the objective of Ind AS 12? Basically, it tries to bridge the explanation between accounts profit, tax profit. Why is there a gap? It tries to bridge that gap. Okay. So with that, this part is clear. Let us then move one step further. So your tax expense will comprise of two hits in the P&L. One is going to be your what we can say, current tax. Another is going to be your deferred tax. Okay. So that is the objective. Then let us move on to the presentation. Okay. I have a question. Okay. So if a person buys a car in the current year and pays the insurance premium for 5 years upfront, okay. So how are we going to record it in the current year? See, typically you have these insurance premiums which run for 5 years. So what some entities do is they treat it as a prepaid expense. So you amortize it 1/5 each year. And the tax department also will accept that contention. So there won't be any timing difference because the tax department also recognizes prepaid expense and tells that you have to book the expense for the year for which it pertains. So in accounting, you will have prepaid expense claimed over the tenure of 5 years. In income tax also, you will have the prepaid expense which is allowable over a tenure of 5 years. That is one way of treating it. Another way of treating it is you capitalize it in the asset and depreciate it. Income tax also permits that. So you could do either of the treatments. Don't complicate your life by saying that I will take it as prepaid in your accounting and I will capitalize it for income tax. That way we are only going to complicate our already complicated lives because of the Ind AS standards. Okay. So now we start with our presentation. Okay. It does not deal only with temporary differences, but it is a major portion of your Ind AS 12. That is why it's very critical that you understand what is temporary differences. Okay. So now coming to Ind AS 12. What are we going to look at is what is the objective? I've already explained, but we'll just formalize it. Okay. We'll see a couple of definitions. I've already covered 2-3 important definitions. So therefore that also is going to be simple. We will look at what is deferred tax and how it is going to get computed. We will look at certain special cases, that is business combination and share-based payments. I don't know how many deferred tax I don't know how well I will be able to do the business combinations questions because you are still not initiated into that, but we'll give it a try. We will look at change in tax status, disclosures, and certain summary questions which are put in the end in your study module. Okay, so that is what I intend to do. Presentation appears to be big, but it's definitely not meant to scare you guys. Okay. It's a fairly simple presentation. Okay. So objective of Ind AS 12. Let us now get into the formal standard. Okay. To prescribe the accounting treatment for income tax. Okay. Accounting for current and future tax consequences of future recovery of the carrying amount of assets that are recognized in the balance sheet. If probable that recovery or settlement will make future tax payments larger or smaller, then the entity should recognize a deferred tax liability or a deferred tax asset as the case may be. Fair enough. So what it is trying to say is because of certain adjustments, the future tax liability becomes higher or lower, you recognize a deferred tax liability or a deferred tax asset as the case may be, which is obviously going to be done. Now, where do I book it in the financial statements? If it pertains to an item in the P&L, I will book the tax impact in the P&L. If that impact goes to other comprehensive income, just now we studied Ind AS 19. In Ind AS 19, change in the values on account of actuarial assumptions, okay, demographic assumptions, financial assumptions, discount rate is changed, mortality rate is changed, salary expectation is changed. If all these things change, which are not typically within the control of the entity, then those items would go and sit in your actuarial assumptions as part of your non-reclassifiable OCI. I think you should be able to recollect and connect with this. It goes and sits in your non-reclassifiable OCI. So any tax impact on such expenditure will also go and sit in your other comprehensive income. Will go and sit in your other comprehensive income. Is it okay? Yes. So standard is very clear. Tax impacts will go to that place where the respective income is booked or where the respective net profit appears. If it appears in P&L, the tax impact goes in the P&L. If it appears in the other comprehensive income, it will go and sit in the other comprehensive income. Okay, so that takes care of this. So if the transactions and events are outside the P&L, then they will be recognized in either OCI or statement of changes in equity. Okay, so that takes care of the first part. Okay, now this one you can go through this later. It is a detailed example. You will not get it in the what you can say in your examination, but it is similar to what I tried to explain to you. Okay. It is similar to what I tried to explain to you. Only thing is they have changed the example. They have changed the example. Okay. So now coming to definitions. Accounting profit or loss. What is this? This is the profit or loss for a period before deducting tax expense. That is your net profit before tax. That is your net profit before tax. Okay. We call it as accounting profit or loss. What comes in your P&L. To this accounting profit, I will add certain expenses non-deductible for tax purpose. Example 43B payments. I will add certain income not recognized, but it is included under tax laws. For instance, revenue that is taxed when the amount is received, though you have not performed the obligation. Less expenses not recognized but deductible for tax purposes. For example, the accelerated depreciation. And less income recognized but not under the tax laws. Example, income accrued but taxed on cash basis. It has already suffered the tax and therefore you will not make it suffer the tax again. So this becomes your movement from accounting profit to taxable profit or loss. Basically, the statement of income that we prepare. This taxable profit is nothing but the net taxable income as per computation of income under the tax laws. Let me be very clear and honest with you. I'm not here to explain in particular the Indian Income Tax Act. Okay, I have only given examples so that you can connect with it. There may be certain examples where you are deviating from the Income Tax Act. कभी आप ऐसे बोल सकते हो सर ये तो tax में है ही नहीं. This is not there in the Income Tax Act at all. Question गलत है. Students will always have the first say, sir, question is wrong. This is not there in the Indian Income Tax Act. You are studying financial reporting. And when you are studying financial reporting, the source, the genesis of this standard is IAS 12. And IAS 12 is a set of principles. It is a set of principles. And when I say it is a set of principles, I mean that it is universally applicable to all the countries which follow IFRS. We are one among them. We call it as Ind AS 12, but it is largely backed on IFRS. And therefore, these principles cater to the principles behind the accounting. It is not focusing on a country specific adjustment. For example, we may have 43B. Some other country may not have 43B. I really don't know. And therefore, what applies there, I cannot have a separate IAS 12 for that. I cannot have a separate IFRS for that. I will therefore say, see, look, these are the principles. You apply this in your respective tax laws. So therefore, we have couple of questions where it does not make sense in line with the Indian Income Tax Act. So don't find a fault in that. Okay. So don't say that it is a fault. We are not here for Income Tax Act study. Okay. Anyways, accounting profit or loss with the tax adjustments is going to give you the taxable profit or loss. What do you mean by tax expense? It is made up of two components, current tax as well as deferred tax. And what is your current tax? Your current tax is the amount of income taxes payable or recoverable in respect of the taxable profit or loss for a period. So that is nothing but taxable profit or loss multiplied by tax rate. Multiplied by tax rate. We saw in our example. Okay. So taxable profit into the tax rate, that gives you your current tax expense. That gives you your current tax expense. Typically, you debit the profit and loss and you credit the provision for tax. Exceptions could be where some items could go in equity or other comprehensive income. It could go in equity or other comprehensive income if the income or expense is recognized in other comprehensive income. Okay. So, provision for tax, how am I going to present it? You can offset against current tax assets if legally enforceable right to set off the amounts and entity intends to settle on net basis or realize and settle simultaneously. So, against this current tax provision, you typically would have ended up paying your TDS, would have been deducted from your revenue. You would have paid some advance tax. You would have paid some TCS. Okay, so all of that go and sit as your current tax assets. So you have those current tax assets, you have the current tax liability. You will, when you file your return of income, what are you going to do? You are going to adjust the tax liability against the assets and do a net off payment. So that is exactly what the standard also is saying. You should do an offset. You can do an offset between current tax assets and current tax liability if you intend to net settle. If you intend to net settle, which we always do. So you present it as a net figure. Present it as a net figure. So what am I going to do? It is measured at amounts expected to be paid to tax authorities. I forgot to put a question mark. You tell me, the provision for tax, is it an estimate or is it a liability? Is it an estimate or is it a crystallized perfect liability that you determine? What is it? What is it? Is it an estimate or is it the final liability? Yeah, that's right. It is an estimate. It's not a liability. What are you doing? Remember income tax. Remember income tax. You remember this word? Self-assessment. Do you remember this word? Self-assessment. मतलब आप खुद अपना liability determine करते हो. You determine the tax liability by yourself applying the provisions of the income tax. Applying the provisions of the income tax. Sir, then when does it become actual? It becomes actual when the income tax communicates. Income tax communicates in two fashions. Either it gives you a confirmation in the form of an intimation, or you get a love letter. You get a love letter in the form of a scrutiny notice or whatever it is. Now, the problem with the income tax is income tax has large number of years for which it can reopen the cases. Okay. There was something like 4 years, 6 years, then you have search and seizure provisions. So therefore, it can open those cases. Sir, then that means the liabilities are never going to be treated as settled until the time span of 6 or 8 years pass. Answer is no, not necessary. You take a reasonable presumption. You take a reasonable presumption. Like for example, the intimation which you get under 143(1), if it is accepting your computation as it is, then there is no major change from the provision which you have recognized. So that kind of closes the entire situation. That kind of closes the entire situation related to income tax. Okay. So it is an estimate. Answer is yes. It is an estimate. You cannot call it as a crystallized liability. The crystallized liability will be said to be so only when you are going to get a notice from the income tax that confirms the fact that what you have filed is what is accepted by the income tax authorities. Okay, so that is when the scenario closes. As of now, it is an estimate. Okay, so don't get confused. Don't get confused. There are many students who say that income tax तो estimate नहीं है sir, it is an actual liability. वो आप compute कर रहे हो. Department may not accept it immediately. Department may not accept it immediately. Okay. All right. Now we quickly go through one question. Okay. This question has been recently introduced in your study module also. Okay. It is a series of questions. Okay. We have, if you have gone through the new study material, you can see that you have illustration 1A, 1B and 1C. Okay. So illustration 1A, 1B, 1C, they are related to each other at different points of time. So right now, if the time is to understand what is current tax, so that is why we are going through illustration 1A. Okay. It's exactly the same question what I have put in here. Okay. So there is no gap here. Okay, fine. We start with the next one, but it's basically an extension of this. So we'll see question 1 quickly. H Limited wants to calculate its taxable profit or loss for the year ended March 20X8. Statement of profit or loss and other comprehensive income, financial position and the notes are given below. Tax rate for financial year 7-8 is 30%. But the new tax rate of 32% of 8, 9 and beyond has already been enacted before the year end. We'll see the importance of this later on. Calculate taxable profit for the year 7-8 and the related current tax expense. They have said only current tax expense. So I will proceed to do that. So you are given extract of P&L, revenue, cost of sales, gross profit, operating cost, profit from operations, finance cost, profit before tax, 59,50,000. You are given the balance sheet. The balance sheet is almost similar. Yes, you can see this 4.2 crores, 21 lakhs, 1.54 crores. Same numbers are there. Same numbers are there. Okay. And here also you can see extract of P&L. Same numbers are there. So the question remains the same. All right. Now, let us move on. Okay. Now, understand. Depreciation expense for 7-8 as per the income tax rules is 72,10,000. Depreciation as allowed for the purpose of financial reporting included in operating cost is 59,50,000. So book depreciation 59,50,000, income tax depreciation 72,10,000. Cost of property plant equipment is 5.6 crores. H Limited deducted expenses of 1 crore 45,60,000 in its tax returns prior to 7/8. Further, as of March X8, H Limited for the first time revalued its property plant equipment to the market value of 4.2 crores, resulting in a revaluation surplus of 30 lakhs 80,000. In 4/5, H Limited had incurred product development costs of 35 lakhs. These costs were recognized as an asset under Ind AS 38 and amortized over 10 years. For tax, H Limited deducted full product development costs in 4/5. So income tax allows the entire deduction, and therefore everything went in the year 4/5. Trading investments were acquired in 6/7, the preceding year, at a cost of 80 lakh 50,000. These investments are classified as at fair value through P&L and thus recognized at their fair value. Fair value adjustments are not allowable by the tax authorities. We will see what is that. Okay. Bad debt provision 45 lakh 50,000 relates to two debtors, debtor X 28 lakhs, receivable of 5/6, 100% provision was recognized in 6/7, and debtor Y 17 lakh 50. You can check 28 lakh plus 17 lakh 50 should be equal to 45 lakh 50. So 17 lakh 50 receivable of 6/7, 100% provision was recognized in 7/8. Tax law allows deduction of 20% of provision for debtors overdue for more than 1 year, another 30% overdue for more than 2 years, and remaining 50% for debtors overdue for more than 3 years. Okay, fairly simple, no complications. Okay. H Limited had created a provision for inventory obsolescence in accordance with Ind AS 2. New provision created in 7/8 was 3,78,000. Total provision 6,30,000. Being a general provision, this provision is not tax deductible. Okay. Government grants are not taxable. Full government grants received in 7/8 is included in the statement of financial position as a deferred revenue grant in terms of Ind AS 20. In 7/8, H Limited increased a liability for product warranty cost by 1,75,000 in accordance with Ind AS 37 on provisions. Product warranty costs are not tax deductible until the company pays the same. Claims paid in 7/8 amounted to 2,17,000. During the year, H introduced medical benefits for its employees. Expenses are allowable for tax purposes only when benefits are paid. But in line with Ind AS 19, you are going to book the expenses in the profit and loss when employees provide the service, obviously. Okay. Penalties towards violation of laws included in the operating expense amounts to rupees 63,000. These are not deductible. Tax law allows to deduct expenses for petrol only up to 1,40,000 per vehicle per year. H Limited had 4 vehicles in 7/8. The total petrol expenses amounted to 7,21,000. Okay. So this is what is going to be your information. Now, the likelihood of getting this question is very remote. Reason being, it is more about trying to explain how to compute. It is more about how to compute your provision. Okay. So we just quickly run through the solution for this. Okay. Because I am not going to waste time on explaining each adjustment. Yeah, that's right. So you have 1A, you will have 1B, you will have 1C. That covers the whole income tax provision, the whole income tax standard for you. Okay. So this is the same question, but I have drafted the solution next to that. Okay. So therefore, I'll quickly run you through the solution. There is no major implication here. You understand each adjustment, do an add less and get to it. Okay. So very simple, as simple as that. Okay. So we start with accounting profit. That's right. The question is huge. You can make it as a small summary of Ind AS 12 into a small book itself. Okay. So accounting profit 59,50,000. All right. Next, we will look at the adjustments one by one. Okay. Depreciation 59 lakh 50, and how much is allowed here is 72 lakh 10. So the same adjustment is done. Add accounting depreciation, deduct tax depreciation. I hope this is clear. Next, product development cost 35 lakhs. For tax, they were deducted entirely in 4-5. So you won't get a second deduction. So product development cost, why 3 lakh 50? Annually, that would only be recognized. So 35 lakh divided by 10, 3 lakh 50,000. So we'll add back that. Nothing is deductible under tax loss because we have claimed full 35 lakhs in the year 4-5. Next, revaluation of trading investments. Okay. So trading investments, you had acquired at 80 lakh 50,000. Right now, it is appearing at how much? Right now, it is appearing at 72 lakh 80,000. Okay. So just pardon the presentation. Okay. Not interested in presentation right now. So I just pumped in the values. Okay. So 72 lakh 80, 80 lakh 50. The difference has gone through the P&L. So 80 lakh 50 minus 72 lakh 80, that gives you how much? That gives you an amount of 7 lakh 70,000. It is a loss. It would have been debited in the P&L. So you add it back. Okay. So I added back 7 lakh 70,000. All right. Next, bad debt provisions. Okay. So let us come. Bad debt provision 45 lakh 50 pertaining to 2. Tax loss allows a deduction of 20% of provision for debtors overdue for more than 1 year, another 30% for more than 2 years, and remaining 50% for debtors overdue for more than 3 years. So first thing is, we are going to add back bad debt provisions. Okay. 28 lakhs pertains to 5-6. Okay. So this is for which year we are doing 7-8. Okay. So 5-6 was the first year, allows 20% of provision for debtors overdue more than 1 year, 30% more than 2 years, remaining 50% for debtors overdue more than 3 years. Okay. Receivable of 5-6, 100% provision was recognized in 6-7. Let us look at the working. I have given the working somewhere. Debtor A. This is the income tax allowance. More than 2 years, 100% deductible in 7-8. 100% deductible in, 30% deductible in 7-8. 8 lakh 40. 8 lakh 40. Okay. So that takes care of this. Tax law allows deduction. Okay. Next one, you have 17 lakh 50, receivable of 6-7. 100% you have booked the expense, but the tax law allows only 20% for debtors greater than 1 year. So 3 lakh 50. So total tax deductible amount in 7-8 is 11 lakhs 90,000. It is 11 lakh 90,000. So therefore, I will add back 17 lakh 50. Okay, I will add back 17 lakh 50, and see, 28 lakh was fully recognized in 6-7. So there is no question of making another provision. But 17 lakh 50, I have booked the entire expense now. So therefore, add 17 lakh 50, okay, and deduct 11 lakh 90,000. Fair enough. Nothing much to do. All right. Inventory obsolescence के बारे में क्या बोलता है? 3 lakh 78, not tax deductible. So add 3 lakh 78. Product warranty cost, what it is asking? Liability is 1 lakh 75. Paid is 2 lakh 17. Take what is paid as an expense. Okay. So 1 lakh 75 added, 2 lakh 17 deductible for tax purposes. Next one. During the year, H introduced medical benefits for its employees. Expenses allowable for tax purpose only when benefits are paid, but in line with Ind AS 19, recognized in profit or loss when employees provide the service. Okay. So now my question is, have the profit and loss somewhere, right? Okay. Here I have medical benefits for employees, 24 lakh 50. So that much expense I will have to disallow, 24 lakh 50,000. Okay. Next. This is done. For tax purposes, we allow it on only payment basis. Penalty towards violation of laws, 63,000. So add back 63,000. And then you have certain petrol expenses. Income tax, 1 lakh 40 per year per vehicle. So 1 lakh 40 into 4 is the maximum you can claim. But you have claimed 7 lakh 21,000. You have claimed 7 lakh 21,000. So 5 lakh 60. Actual expenses 7 lakh 21, excess is 5 lakh, sorry, 1 lakh 61. Okay. So therefore, if we come to your solution, petrol over the limit is 1 lakh 61,000. Okay. 1 lakh 61,000. So that gives you total taxable profit or loss, tax rate, current income tax, and this is the journal entry. This is the journal entry. Profit or loss account debit, that is the current tax expense. Credit, current income tax liabilities. Current income tax liabilities. Are we clear so far? Are we clear so far? Anybody has any doubts in this? You are only getting familiar with the fact that accounting profit and taxable profit are two distinct things, and how it is calculated, one sample example is given for your reference. Okay, nothing else. Now coming to the other part. Sir, what do you mean by deferred tax? Amount of income tax is payable or recoverable in future. Payable or recoverable in future. In respect of temporary differences, we saw this with the help of that 43B disallowance, unused tax losses and unused tax credits. This we are going to see later. So temporary difference into the tax rate gives you deferred tax, And then we have two new terms, carrying amount and tax base. Carrying amount and tax base. What is that? We are going to see this. Is it okay? Yes. Anybody has any doubts so far? Anybody has any doubts, difficulties? Okay, just give me a minute. I'll just come. Can I explain debtor A calculation? Okay, fine. Where is that debtor adjustment? Okay. All right. Bad debt provision is 45 lakh 50 and relates to two debtors X 28 lakhs 56 100% provision was recognized. Debtor Y 17 lakh 50,000. Okay. Debtor X. Debtor X. Accounts tax. See, debtor X, this fellow became bad in 5-6. So 100% provision was recognized in 6-7. So 20x67, you have already booked how much? Sir, I have already booked 28 lakhs. Okay. That means I won't be booking this provision again. Now for tax purposes, what does it say? For tax purposes, it says that 28 lakhs receivable of 5-6 20% provision overdue more than 1 year. Overdue more than 1 year. So that comes to how much? That comes to 6, 7. This is a 5, 6, right? We are preparing financials of 7, 8. 7, 8. So, how many years have passed since it has become overdue? Sir, we have passed 6, 7, 7, 8. That means more than 2 years. That means in the current year, I can claim how much? Another 30% for debtors overdue for more than 2 years. And therefore, that is going to be 28 lakhs into 30%. 28 lakhs into 30%. So that will be 8 lakh 40,000. That will be 8 lakh 40,000. Is it okay? Have you understood? Next. Debtor Y. Debtor Y. We have booked the entire expense in the current year, 17 lakh 50 provision. But for your tax purposes, it is the first year, more than 1 year overdue. So therefore, debtor Y is going to be 17 lakh 50,000 into 17 lakh 50,000 into 20%. So that is equal to 3.5 lakhs. So allowable expenditure is 11.9 lakhs under the tax laws. Are we clear with this? Yes, Mohammed, did you follow? Is your doubt clarified? Okay, fine, good. So let us then proceed further. Yeah, now we look at two small questions. Okay, solution is there. I'll share this PDF with you. You don't have to worry. Okay, but this is for your understanding on deferred tax. TriStar acquires a machine for 8 lakhs, decides to depreciate its straight line over its useful life of 5 years. Income tax legislations allows depreciating machines straight line over 4 years. It does not allow. I know you have WDV, I know you have block method, but yahan pe we are not studying income tax, we are studying Ind AS 12. So don't jump to Income Tax Act. Okay. In years 1 to 5, TriStar's taxable income before tax depreciation expense is 4 lakhs and the tax rate is 30%. Show TriStar Limited's current tax expense, deferred tax expense, DTA, DTL, and the net profit in years 1 to 5. Okay. So now let us start. Same question, solution also is there. I can run through the solution so that I can cover more things with you. Okay. All right. Now, you start off with 8 lakhs. So 8 lakh is your year 1 opening value. Each year accounting depreciation is over 5 years. So 160 each year, 8 lakh divided by 5. So your closing carrying amount is arrived at. Okay. Last year it becomes 0. Last year it becomes 0. Now, let us move on to the next one. Okay. Let us move on to the next step. Your net profit for all the 4 years is 4 lakhs. For all the 4 to 5 years, sorry, it is 4 lakhs. So 4 lakhs each year. Income. Deduct accounting depreciation. So that gives her profit before tax of 2,40,000. That gives her profit before tax of 2,40,000. Okay. Now, your tax expense at the rate of 30% should be 72,000. Each year it should be the same. So your net profit should have been this. Important words should have been, but they aren't. But they aren't. Okay, so let us see what is the anomaly. Let us see what is the anomaly. What is the reason for the gap, if at all there is any. So tax depreciation, you are allowed over a tenure of 4 years only. Over a tenure of 4 years only. So 6 lakh, 4 lakh, 2 lakh is your closing carrying amount. Is your closing carrying amount. Okay. And now let us come to current tax expense. Let us now come to current tax expense. Okay. So taxable income is 4 lakhs. Tax depreciation 2 lakhs for 4 years. Last year nothing is there. So therefore taxable profit is 2 lakh for the first 4 years. And in the end it is 4 lakhs. So tax expense will be 60, 60, 60, 60, 120. Are we clear till now? Are we clear till now, or any doubt is there still? Everybody confirm. So far, is it okay, or you still have any difficulty still here? Is it clear so far? Tanisha has confirmed. No. Yes, she has confirmed. Muhammad Yedu. What about the other? Shailesh, Yukta, Yedu. Yedu has confirmed. Yes. Yukta, Niveta, Tariq, Mansha, Shruti. Is it okay? Yes. Kirti, are you fine? Suraj, Shailesh. Yes. Please confirm. Okay, Manoj is there. Good. So far it is clear. So far it is clear. Okay. All right. Fine. Now let us move on. So if I start my books now, net profit is 4 lakh, 4 lakh, 4 lakh, 4 lakh, 4 lakh. Accounting depreciation 160 each year. So profit before tax is 2 lakh 40. Tax expense 60, 60, 60, 60, 120. It is basically these amounts. Okay. It is basically these amounts. So your net profit is 180, 180, 180, 180, 120. What is the distortion you see in the net profit? What is the distortion you see in the net profit? What is the distortion you see here? Do you see something normal, abnormal happening here? Yes or no? Is it normal to see this, or is there something abnormal here? बोलो यार, इतना तो बोलो, is it normal or abnormal? If it is difficult to type the whole thing, just tell me, is it abnormal or normal? Okay. All right. Fine. Look in year 5. Income is 4 lakhs. This is your books of accounts. Okay. This is your books of accounts. Okay. So 4 lakhs. Accounting depreciation we deduct. Profit before tax. Till here, everything is normal. Till here, everything is normal. The tax expense is giving a problem. 60, 60, 60, 60 for 4 years. Fifth year mein, suddenly it jumps to 1,20,000. Suddenly it jumps to 1,20,000. Yes, that's right. Sir, how did I get 60, 60? Sir, this is from computation of income. This is from computation of income. So therefore, this tax expense is exactly as per the computation of income that is there. As per the computation of income that is there. Now, years 1 to 4, the tax rate 60 divided by 2,40,000. That comes to how much? Sir, that comes to 25%. In the fifth year, 1,20,000 to 2,40,000, this comes as 50%. And now, if you are somebody who has invested in this company for 5 years, then you will be looking at a 25% tax rate on net profit for the first 4 years and suddenly 50%. And then the questions will start flowing in. How did it become 50%? Is there an increase in the tax rate? But itna to nahi ho sakta. How did it happen double? Why were we not informed before that the tax rate will be doubled? Why is the company taking 50% against 25%? All these questions will start to come. So therefore, year 5 is an abnormality. Year 5 is an abnormality. Now, why this abnormality has arisen? This abnormality arose on account of higher depreciation in respect of income tax versus lower depreciation in case of books. That is the main cause for this anomaly. Is it okay? Yes. Is it fine? Yes or no? Is it fine? So far, is it okay? Yes. Is it fine till now? Look at these two lines now. Your tax expense should have been 72,000. That is net profit before tax multiplied by the tax rate. But actually, your tax expense is 60,000. That means in the first year, you have a saving of 12,000. Second year also 12,000. Third year also 12,000. Fourth year also 12,000. Fifth year is curious. 72,000, 1,20,000. The gap is 48,000. The gap is 48,000. Can you see some relation in this? Can you see some relation in this? 12,000, 12,000, 12,000, 12,000, 48,000. What is the relationship between this? What are you able to make out from this difference? It is A, B. A minus B. What can you make out from A minus B? Okay. That's right. That's right. Each year you are paying less. Each year your income tax is lower by 12,000. Sir, why? Because your depreciation is 1,60,000 as per the books, but income tax allows you 2 lakhs. But income tax allows you 2 lakhs. So you are getting 40,000 additional depreciation. You are getting 40,000 additional depreciation. On that, 30% tax comes to 12,000. On that, 30% comes to 12,000. And this 12,000 is the exact tax saving that we are undergoing. Is the exact tax saving that we are undergoing. But now tell me, is this a tax saving or am I only postponing the payment to the future? Is this a tax payment? Is this a genuinely reduced tax payment or is this only postponement of the tax liability? Is this only the postponement of the tax liability? What do you think? Is this a genuine saving or is it a postponement? Come on, tell me. It is a postponement. Sir, year 1, I claimed depreciation of 1,60,000. Year 1, for tax purposes, I claimed a depreciation of 2 lakhs. So I am claiming an additional how much? I am claiming an additional 40,000 in year 1. I am claiming an additional 40,000. So 1,60,000, 2 lakhs. Additional 40,000 in year 2. Additional 40,000 year 3. Additional 40,000 year 4. Is it okay? Additional 40,000 year 4. Year 5, 1,60,000 versus 0. 1,60,000 versus 0. I'm not paying anything extra. I'm not paying anything extra. Are we clear with this? Yes. Are we clear with this? And therefore, whatever savings in whatever additional depreciation I had gotten the benefit of, whatever additional depreciation I had gotten the benefit of in years 1 to 4 gets vanished or gets reversed in year 5. Gets reversed in year 5. And therefore, A minus B, 12,000, 12,000, 12,000, 12,000 versus 48,000 versus 48,000. Okay. Opening carrying amount is this. See, machinery for 8 lakhs, 8 lakhs, and then opening. Okay. That's it. Okay. Closing of 1 year is opening of next, and the first year is your procurement. Okay. All right. So 12,000 each year postponement for settlement in the last year. For settlement in the last year. In the last year, accounting profit 1,60,000 is your depreciation. Tax, no depreciation adjustment in the last year. So into 30%, this comes to 48,000. This comes to 48,000. Are we okay with this? Yes. Are we okay with this? So therefore, your tax saving of 12,000 each year culminates in an additional tax payment of 48,000 in the fifth year. So that goes and forms part of your deferred tax liability. This 12,000 goes and sits as part of your deferred tax liability. Your deferred tax expense 12 minus 48,000. In the last year, whatever liability you have accumulated, that starts to get reversed. Okay. So now how does my accounting P&L look like? 4 lakh minus depreciation 2 lakh 40 minus current tax expense 60,000. So 1 lakh 80. Deferred tax expense 12,000, which is this one. Okay. Okay. So that comes to 12,000, 12,000, 12,000, 12,000, and finally 48,000 reversal. So that comes to 168 each. That comes to 1,68,000 each. And this is normal. This is normal. Okay. Kirti, hope your query got sorted out. Yes. This now makes infinite sense. The reader of financial statements will now look at 60,000, 12,000, 72,000. Same goes here, same goes here, same goes here. And then here, 120 minus 48. So 72,000 each month. $72,000. Are we clear with this? Yes. So this is how Ind AS 12 seeks to mitigate the time lag, seeks to mitigate the temporary difference, seeks to account for the temporary difference. In each year, 12,000 was my liability. In the fourth year, in the fifth year, that liability starts to get reversed. Are we clear with this adjustment, with this explanation? Yes. Are we clear? So basically, I have not saved the income tax. See, when I say deferred tax asset or liability, you have not saved it. You have merely pushed. You have merely pushed to the subsequent period. You have merely pushed the tax payment to the subsequent period. Yes. Are we clear with this, everyone? Please confirm. Yes, in the last case, no. Last case, profit won't be 72,000. As of now, where is my accounting profit? That's right. In the last case, 1,20,000 is your tax expense. Net profit is 1,20,000. Nah. This net profit won't be 72,000. It will be 1 lakh. See, what will happen in the last year is you went on creating a liability of 12,000, 12,000, 12,000, 12,000 each year. In the last year, in the fifth year, that liability gets reversed because the asset is now depreciated in accounts also. So therefore, the liability gets reversed to 48. So it is 1,20,000 minus of minus 48. So it becomes 1,68,000. It becomes 1,68,000. Are we clear with this? Yes. it is 180 minus 12, 1 lakh 80 minus 12, 1 lakh 80 minus 12, and 1 lakh 20 minus of minus 48. So that comes to 168. So basically what we are trying to say is, when everything else remains the same, income tax cannot be the reason for different net profits. So we have to treat it at par, and therefore we have done the accounting in this manner. Are we okay? Yes. All right. Anybody has any doubts here? See, you have any doubts here? I will get it solved immediately. But if you don't tell me now, next couple of weeks down the line, you will face lot of difficulty. You will face lot of difficulty or confusion. Okay. So anybody has any doubts here, please confirm. If everything is clear, please let me know. Manoj, Yadu, Kirti, Tanisha, Mohammed, Tariq, Suraj. Yes. Please put in your answers. It's clear to everyone. Okay. All right. Fine. So that explains your deferred tax liability. What I want you to do is, I want you to do a similar question. I want you to do a similar question. Okay. Question 3. Question 3. TriStar obtained a bank loan from a scheduled bank, the interest on which amounted to 40,000 per annum. As per section 43B, I just put it to add a little bit of flavor, but even if it was not required, it is fine. Interest on bank loan will be deductible for tax purposes only when it is actually paid. Due to cash flow problems, the company could not pay the interest accrued for years 1 to 4. It settled all the interest dues in year 5. The borrowing was repaid at the end of year 5. EBIT of the company for each of the years amounts to 4 lakhs. Assuming all other components forming part of the EBIT are accounted identically for tax purpose as well as for financial accounts, show TriStar Limited's current tax expense, deferred tax expense, DTA or DTL, and the net profit after tax in year 1 to 5. In years 1 to 5. Okay. I want you to solve this exactly like how question 2 is there. Okay. Exactly like how question 2 is there. Okay. So therefore, this is the format. Okay. 1, 2, 3, 4, 5. And then the difference in taxes and then deferred tax. Okay. You want to do it now or you want to do it for homework? You want to do this question now or you want to do it for homework? You only have to do it. You only have to do it. Don't look at me. Okay, sir करेंगे करके. Yeah, you want to do this for homework? Now. Okay, then try this. Try this. Try this. Everything is the same. Only thing is this is a bank loan, whereas the earlier question it was depreciation. This is interest on bank loan. Okay. Two are saying homework. What about the others? Okay, fine. You can do it for homework then. I'll share this presentation and I'll share the assignment also. Assignment has the solution. Okay. Sir, what is the difference between deferred tax expense and the DTA or DTL? The deferred tax asset which you recognize will have a corresponding double effect. Na? See, you are studying accounts. In accounts, everything is double. In accounts, everything is double. So, if I recognize the DTL, DTL means liability. Liability means credit. So if I credit to book the liability, I have to debit somewhere for the expense. No? So that is known as deferred tax expense, which goes to the P&L. In rare cases to the other comprehensive income. Same applies for this one. Deferred tax asset. Asset means debit. So I have to credit something. I have to credit something. And that something is what is going to be my deferred tax charge, or sorry, deferred tax credit. It will be my deferred tax credit. Are you clear, Kirti? Yes. Okay. So that takes care of the basics. That takes care of the basics. And now we shall come to the actual steps prescribed in Ind AS 12. We shall now come to the actual steps prescribed in Ind AS 12. We shall now begin with the steps. Step number 1, compute the carrying amount of assets and liabilities. Step number 2, compute the tax base. Step number 3, compute the temporary differences. Step number 4, classify the temporary differences into taxable or deductible temporary difference. Step number 5, identify exceptions. Step number 6, assess deductible temporary differences. Step number 7, determine the tax rate. 8, calculate and recognize deferred tax. 9, accounting of deferred tax. And 10, offsetting the deferred tax. Okay. So that is what the whole deferred tax working is all about. So for today, we will be focusing on step 1. We will be focusing on step 2. We will see the implications of step 3 and step 4. If we can do this by 10, it will be a great achievement. But at least the first 2 steps has to go. Compute temporary difference is nothing. It will be step 1 minus step 2. So, उसमें कुछ भी नहीं है. Step 4 is what you need to understand. Okay. Then the exceptions, all the remaining steps, we can do it tomorrow. We can do that tomorrow. Okay. Are you okay to start step 1? Are you okay to start step 1? Okay. Sir, we are okay. We can start. So, carrying amount. What do you mean by carrying amount? Carrying amount means जो book में value है, that is the carrying amount. See, I explained to you deferred tax impact. From a profit and loss perspective, I explained to you the deferred tax impact from the profit and loss perspective. Is it okay? Yes, I started with NPBT. So this is the P&L perspective. This also is the P&L perspective. But Ind AS 12 tells us no, you will not use the P&L perspective. You will follow the balance sheet perspective. You will follow the balance sheet perspective. That means we are not going to look at the computation, profit and loss, etc. We are directly going to look at the balance sheet and arrive at our deferred tax. Now that is the change that is major as compared to AS22. AS22 followed a P&L based approach. AS22 followed a P&L based approach. Ind AS 12 requires us to follow a balance sheet approach, which is why two things become critical. One is your carrying amount, the other is your tax base. You have to identify what is your carrying amount and what is your tax base. Okay. So coming back to our discussion, what is the carrying amount? Sir, carrying amount kuch nahi hai. Carrying amount is the amount that goes and sits in your ledger. It is the ledger balance. It is the closing balance as per your books. It is the amount which appears in your financial statements. It is the amount which appears in your balance sheet. These are identifiable amounts which appear in your financial statements. Okay. So, it is an amount at which an asset or liability is recognized in the balance sheet after making necessary adjustments like depreciation, impairment, etc. Okay. So, this is balance as per ledger. That is balance as per ledger. That is financial statements. Financial statements. Okay. Is it clear? No doubts. So let us look at one or two examples. Okay. Entity A had acquired an item of plant and machinery for 1 lakh on 1st April X1. Depreciated this item at 10% on straight line basis. For the year ended March X2, it provides depreciation of 10,000. What would be the carrying amount? What would be the carrying amount of this? So 1 lakh is your plant and machinery, and the depreciation on that at 10% would be 10,000. So the net amount is going to be 90,000. This 90,000 becomes your carrying amount. This 90,000 becomes your carrying amount. Okay. That's right. That's right. Okay. So this becomes your carrying amount. Is it okay? Anybody has any doubts here? Any difficulties? Any clarity needed? Yes? Or can we proceed further? Okay. So this is the easiest part. And now we come to the major discussion, that is computing the tax base. We now come to the major discussion, that is computing the tax base. We take a 15-minute break, get fresh, and then we discuss tax base. Okay. And then we discuss tax base. So as of now, you people are slowly coming into the picture. You people are slowly coming into the picture. That's right. Carrying amount is the book value. Absolutely right. Okay. So we take a 15-minute break and then we shall resume at 9 with the tax base workings. Okay. Today we have to complete what is my tax base. Okay. So take a break and we resume. Okay. All right. Welcome back. So now coming to tax base. What is the tax base? We saw the carrying amount. Carrying amount is the book value. What is appearing in the financial statements? Basically the ledger balance. So that makes it fairly simple for understanding what is the carrying amount. Now coming to tax base. What do we mean by a tax base? As I said, we have now shifted from a P&L based approach to a balance sheet based approach. That is why they are saying tax base of an asset or a liability. They never talk about tax base of an income or an expense. That is not going to be the manner. So now it is basically an amount attributed to an asset or liability for tax purposes. What is tax base? It is an amount attributed to an asset or liability for tax purpose. So if I talk about an asset, and economic benefits flowing from that asset are taxable, if the economic benefits flowing from that asset are taxable, then the tax base is the amount deductible for tax purposes against any taxable economic benefits that will flow to an entity when it recovers the carrying amount of the asset. Okay. See, the definitions are very complicated, but let us understand the definitions. Then we will move to understand how can I simplify the tax base understanding. It is very simple. Definitions look to be complicated, but they actually are not. Okay, but they actually are not. Okay, so now coming to tax base. Okay. It is the amount deductible for tax purposes against any economic benefits that will flow to an entity when it recovers the carrying amount of the asset. Okay. So now, suppose I have an asset. The asset cost is 1,000. This asset is a plant or machinery or equipment. So if this is plant, machinery, equipment, it is obviously going to be used in the manufacturing. The manufacturing of this is going to give rise to a revenue, which will be taxable. So economic benefits flowing from this asset are taxable. Then the tax base is the amount deductible against those benefits. So ये asset है. Against this asset, I will get revenue. Against this revenue, I can deduct the cost. Sir, can I deduct the entire asset value? Answer is yes. There is nothing that can stop me from deducting. I will deduct it in the form of depreciation each year. That is okay. It is not saying everything should be deductible in the year in which you generate economic benefits. It is saying over the tenure of the assets, when you generate economic benefits which are taxable, then your tax base is going to be the amount that is deductible. That means this depreciation which is deductible. And sir, depreciation deductible will be equal to the value of the asset. Depreciation that will be deductible is going to be nothing but the value of the particular asset. And therefore, your tax base in this case is going to be the asset value of 1,000. Is going to be the asset value of rupees 1,000. So therefore, you have an asset. That asset generates economic benefits. Those economic benefits are taxable. Against those taxable benefits, how much am I going to deduct for the purposes of income tax from this asset becomes your tax base. The deductible amount of this asset becomes a tax base. So if I have a property, plant, equipment, I am going to deduct what? I am going to deduct the carrying amount of that asset or the value of that asset in the form of depreciation. So the value of that asset ends up becoming my tax base. Are we clear with this? Yes. Am I clear with this? Anybody has any doubts in the first approach of tax base? Yes. In the first approach of tax base, anybody has any doubts? No doubts? Bolo. You guys are still in break, huh? Yes. Yes. Okay. As of now, don't worry, sir, ये कितना complicated definition है. Don't worry about that. I'll tell you a very simple way of understanding tax base. You will not go wrong in that. But for now, we understand the language of the standard. Okay. We understand the language of the standard. Okay. Sir, सिर्फ you talked only about property, plant and equipment. What does it? When it recovers the carrying amount of the asset means what? Okay. Kirti is asking what does it mean by recovering the carrying amount of the asset? See, why do you buy an asset? Why do you buy an asset? This laptop on which I am taking your session, this iPad on which I am taking your session. Why do I buy this? Why have I invested in this? Yes. Answer. Why have I invested in this? Revenue generation. That's right. Revenue generation. So, you deploy the asset for use. You put it to manufacture something. That something which you put for manufacturing, that asset cost, you have to recover it from the activity. Yes or no? That asset cost, you have to recover it from continued activity to generate income. That asset should be put to use to generate income. आप उसको ऐसे नहीं रख सकते idle. You cannot leave it idle. You have to use it. And when you use that asset, you are essentially recovering the carrying amount. Recovering means what? You paid money and now you are putting it for use, and against this use you are generating income. तो उसको हम लोग बोलते हैं recovering the carrying amount of the asset. We call it as recovery. On one side we put this asset for use and recover the carrying amount. The other side I depreciate this asset. So that is how the matching concept tallies. That is how the matching concept tallies. Have you understood, Kirti? Yes. Recovering the carrying amount of the asset. Did you understand? There is Tanisha. Is she there? What about Shruti? Are you there? What about Yukta? Are you there? Niveta, Mansha, are you guys there? Yes. What about boys? Mohammed, Tariq, Shailesh, Viraj. Yes. Did you understand recovering the carrying amount of an asset? Yes. Okay. Perfect. So that is taken care of. Now, if the economic benefits are non-taxable, if the economic benefits are non-taxable, then the tax base is equal to the carrying amount of the asset. Okay. This is an exception. Most probably we fall in this case. Most probably we fall in this case. Okay, fine. Coming to liability. Coming to liability. What is the tax base of a liability? Okay, so now, but sir, carrying amount is after the depreciation. We can only recover the cost. See, when I recover the cost, I don't recover the cost immediately, right? I will obviously recover the cost over the tenure. So today I am recovering up to the, so today I am recovering an amount. Next year, I have to recover only up to its carrying amount, that is up to the WDV. The third year, I would charge the depreciation and show the balance that is being deployed. So I have to recover the carrying amount. I have to recover the carrying amount. So therefore, the cost goes on reducing on account of depreciation, and you are going to deploy that asset, continue to deploy that asset to generate income, and therefore you are recovering the carrying amount of the asset. Okay, so that takes care of that query. So now coming to liability, the tax base of a liability, थोड़ी टेढ़ी definition है, it is a little crooked. Okay, tax base of liability is the carrying amount less amount deductible for tax purposes in respect of that liability in future periods, if any. Okay, so the tax base of a liability is carrying amount minus amount deductible for tax purposes in respect of that liability in the future periods, if any. Okay, this is your tax base. In the case of asset, it was straightforward. Against the economic benefits, whatever amounts are deductible, that deductible amount itself was the tax base of the asset. Whereas in the case of liability, the tax base is the carrying amount, that is the book value, minus amount deductible for tax purpose in respect of that liability in future period. That gives you tax base of liability. If revenue is received in advance, tax base is its carrying amount less any revenue that will not be taxable in the future periods. Okay. Did you at least become familiar with the definitions? Did you at least become familiar with tax base of asset, tax base of liability? थोड़ा सा familiarity है? Yes? Or you still have any clarifications? See, it will be clear with examples. Don't worry. And we have lot of examples. But as of now, definition is okay. Yes. You can say that it is not okay. We need more clarity, which is why I'm waiting for you guys to tell that. You don't have to struggle to tell me that you have understood when you have not understood, or if you are finding it complicated. Okay. It is everybody, yaar. Okay. Suraj has responded. Okay. All right. Fine. When you are going to compute the tax base, please don't look at this. You will go crazy. Okay. If you start applying this definition very sincerely, I can very sincerely tell you that you will go a little off track, and the chances of mistakes go very high. Okay. Instead, think it off like this. Okay. When you are going to compute the tax base, think it off like this. Assume that you are preparing a separate income tax balance sheet. You are preparing a separate income tax balance sheet. In that income tax balance sheet, whatever will be the value of these assets and liabilities, that itself becomes your tax base. Simple, no complications at all. In that income tax balance sheet, whatever will be the value of assets and liabilities, that itself becomes your tax base. Because that itself is the definition of tax base. That itself is the definition of tax base. It is amount attributed to an asset or liability for tax purpose. So we notionally assume that I am preparing an income tax balance sheet. In that income tax balance sheet, what will be the carrying amount? That amount you will write it, and that itself will be your tax base. Okay, that itself will be your tax base. Okay. So with that background, keep only that background in mind. Don't look at all these definitions. Okay, ये सारे definitions नहीं चाहिए. It's not required. The standard has given us this guidance, no doubt, no doubt. But instead of these definitions, understand that I am preparing two balance sheets. One balance sheet, Ind AS, another balance sheet, income tax. So therefore, if both the places it is the same, there is no difference. If it is different in the income tax, please take the income tax provisions and identify the balance sheet, identify the value. Yes, as per the tax records. The difference between the two is going to be regarded as temporary or not temporary difference. That is a subsequent matter. Okay. So as of now, tax balance sheet. So let us look at some questions. Let us look at some questions. Okay. Now, entity A had acquired an asset for 1 lakh on 1st April 20x1. It depreciated this item at 10% per annum on straight line basis. As per taxation laws, it has to be depreciated at 30% per annum on WDV basis. So carrying amount, tax base. What is carrying amount? Sir, my carrying amount is going to be cost 1 lakh, depreciation 10%, na? So 10,000, so 90,000. This becomes your carrying amount. This becomes your carrying amount. The same asset for tax base, the cost is 1 lakh, but depreciation is 30% WDV. So here it will be 30,000. So 70,000. 70,000. Yes. In the tax balance sheet, what value will appear? Sir, 70,000 will appear. In the Ind AS balance sheet, what will appear? Sir, 90,000 will appear. So carrying amount is 90,000. Tax basis 70,000. Tax basis 70,000. Have we understood the first part? Yes. Have we understood the first example? Yes. Example 4. Did you guys follow? Okay. Next. Mansha, did you follow? Yes. Okay. Entity A has inventory. Okay. I'll rub this part. You don't need it. Okay. Entity A has inventory with a carrying amount of rupees 1 lakh at the reporting date. Okay. Now, carrying amount is 1 lakh. It recovers the value of inventory through sale in a subsequent reporting period. Have they given you income tax any adjustments? Answer is no. So income tax के case में भी if it is an income tax balance sheet, see inventory has to appear there because you have inventory. So my income tax balance sheet also will have inventory of 1 lakh because no further adjustments are being mentioned by the income tax department. Okay. The income tax department will say that your inventory is 1 lakh only, जो तुम्हारे books में है. And therefore, the department contends with that value of 1 lakh without giving any adjustment, which is not there in this problem. And therefore, the tax base of the inventory also remains as 1 lakh. Remains as 1 lakh. Are we okay with this? Are we okay? Any doubts? Okay, next. Let us proceed to the next one. It's very simple. Think that you are preparing income tax balance sheet also. You will get the answer immediately. Entity A has acquired an item of asset for rupees 1 lakh. So cost 1 lakh. यार इसमें तो there won't be any difference. Okay, cost to 1 lakh hai. If it was income tax balance sheet, there also I am paying cash of 1 lakh only, and therefore cost is 1 lakh. It is deductible equally over 2 years. So depreciation 50,000, 50,000. Okay. So year one, it is 50,000. Year two, it becomes zero. It becomes zero. That's absolutely right, Suraj. For tax purposes, 75,000 is deductible in year one. So 75,000 is deductible in year one. So you are left with 25,000. And balance is deductible in year two. 0. So now, can you tell me what will be the tax base of this asset in year one? What is the tax base of this asset in year one? What is the tax base of this asset at the end of year one? What is the tax base of this asset at the end of year two? Absolutely right. Yes, the tax base is 25,000. The tax base is 25,000. At the end of year two, done. Anybody has any doubts with 25,000? Please ask. For year two, it is 0. So this is your tax base for year one. And for year two, tax base is 0. Tax base is 0. Absolutely right. Okay. Next. Interest receivable has a carrying amount of rupees 100. The related interest revenue will be taxed on a cash basis. Interest receivables has a carrying amount of 100. The related interest revenue will be taxed on a cash basis. Will be taxed on a cash basis. Think about this statement and tell me what will be the tax base. What will be the tax base? Think. Yes. The interest revenue will be taxed on a cash basis. Don't go to the future. Think as of now, Suraj. Okay, think as of now and tell me what will be the entry. Very simple, ma. Don't ever break your head so much. Pass journal entries. That will solve all your doubts. So carrying amount, you would actually pass the entry interest receivable account debit to interest income. To interest income 100. Now, if I come to income tax, will I pass this entry or will I say I will pass the entry only when cash is collected? I will pass the entry only when cash is collected. Sir, you will pass the entry only when cash is collected because here it is given that you are going to account for it for tax purposes only on cash basis. That means today's date, when you have the carrying amount getting recognized, there won't be any entry in the tax records. And if there won't be any entry, then the tax base is going to be zero. Are we clear with this? Yes. Are we clear? Yes, you haven't received the cash, but you will not recognize interest receivable in income tax because income tax is going to account for it on collection basis. Sir, where it is given? It is given in the problem. Yes, and therefore, the carrying amount of interest receivable is 100, but the tax base of that is unfortunately going to be 0. Yes. Have you understood? Yes. Suraj, did you follow? Okay, looks like Suraj followed. Yes. Kirti, did you follow? When cash is received, what entry? Okay, sorry, why did I erase that? When cash is received, cash account debit to interest. Here when cash is received, cash account debit to interest receivable. So therefore, when the cash is collected, the carrying amount of interest receivable becomes zero. And for tax-based purposes, then also you will not have it. Where am I entering the interest receivable in the tax records? I am not entering. I have taken cash account debit to interest. Income. This is a P&L item. So it will go straight away to the profit and loss. But cash account debit to interest receivable, this carrying amount becomes nil. This carrying amount becomes nil. And the tax base also remains at zero because interest receivable has not come only. Interest receivable has not come. Whatever cash has come, it's entirely pushed to the profit and to the taxable income. Is it okay? Yes. Have you understood? All right. Next. Next. An entity that follows mercantile system of accounting has trade receivables of 1000. It creates a general bad debt allowance of 50. However, in income tax, general bad debt allowance is not deductible. The related revenue has already been included in taxable profit. So now, carrying amount taxless. Yes, tell me, what will be the tax base here? Debtors 1000, provision 50, so 950. Whereas here, debtors तो same रहेंगे 1000, but for provisions you are not allowed 1000. That's right. That's right. Nothing is allowable as a deduction under the tax laws. So therefore, provision is 0 and 1000 is going to be your tax base. 1000 is going to be your tax base. Are we clear with this? Yes? Absolutely. So Shruti is right. Suraj is right. Yadu is right. Okay. So this becomes your carrying amount and tax base. Okay. Done. Next, an entity that follows mercantile system has receivables of 1000, creates a specific bad debt of rupees 50. In income tax, specific bad debt provision is deductible in the very year it is created. Okay. All right. So carrying amount, there is no change. 1000 minus 50, 950. Next, your tax base. You will be having 1000, and here they have said specific. Here, for a change, it is deductible. They have mentioned it here. See, in income tax, specific bad debt provision is deductible in the very same year in which it is created. Yes. So therefore, here also your tax base will be 950. Are we clear with this? Yes. Specific bad debt provision is deductible. Yes. Absolutely right. Okay. Okay. Perfect. Next. Go through 10 by yourself. Go through 11 by yourself. Okay. It's very simple. Next. Example 12. Current liabilities include accrued expenses with a carrying amount of rupees 100. Related expense will be deducted for tax purposes on a cash basis. Example, unpaid employer's contribution to Provident Fund 43B. Okay, 43B. Now, I want you to tell me what is the tax base. Absolutely, absolutely. The liability will never be booked in tax records. Why? Because the expenditure is allowed only on payment basis. So liability, there is no need to book. So therefore the therefore the uh, tax base is going to be zero. The tax base is going to be zero. Are we clear with this? Yes. Great. Great. Next. Current liabilities include accrued expenses with a carrying amount of 100. The related expense has already been deducted for tax purposes. Example, outstanding salary for March. Yes. The remaining expense, the related expense has already been deducted. That means it is not paid but already deducted for tax purposes. That means tax base is going to include, your tax base is going to include those expenses which is only accrued. So for example, expense account debit. Expense account debit to current liabilities. Are we clear? Yes. Are we clear? So the tax base in this case, they have said, see, the related expense has already been deducted. That means what? They have actually passed this entry, expense account debit to current liability. That means the what you can say, the expense booking has happened on an accrual basis. So therefore, the current liability value also is going to be how much? It is going to be 100. Tax base is going to be 100. They have not said it is deductible on, they have not said that it has already been deducted for tax purposes, and therefore you can consider it as if an entry has been taken for tax purposes, and therefore you are now going to accrued expenses. You are now going to consider it as a tax base of 100. Done? Done? Kirti, did you follow? Yes. Tax base and accounts will be the same in the 13th question. That's right. That's right. Done? Are we able to follow? Yes. Okay, fine. Carrying amount, taxes. Current liabilities include accrued expenses with a carrying amount of 100. So therefore, expense account debit to outstanding 100. This entry is passed in your books. The related expense has already been deducted for tax purposes. That means the income tax allows you to claim expense. So here I will have expense account debit. But did my cash go? Answer is no. It has still not gone. And if it has still not gone, in the tax records also, I will have outstanding of 100. Yes or no? And because I have outstanding of 100 there, the tax base of that becomes 100. The tax base becomes 100. Are we clear with this? Yes. So therefore, the tax base equals the carrying amount equals rupees 100. Kirti, did you follow? Done? Okay. Next. Okay. Current liabilities include accrued fines and penalties with a carrying amount of 100. So therefore, okay, it includes accrued fines and penalties with a carrying amount of 100. So fines account debit to outstanding fines. 100. Acha. What about income tax? What about income tax? What about income tax? Well, they are not deductible for tax purpose is a separate issue. They are not deductible for tax purposes is a separate issue. So in the absence of information, here also I will have fines account debit to outstanding fines. 100 to outstanding fines 100. Now, sir, but these are not deductible. Agreed. These are not deductible. These are never deductible. I will go one step further and say these are not deductible now. They are never deductible. That goes and sits in your exceptions. But for now, the tax base equals the carrying amount equals 100. Is it okay? Yes. Are you clear? Yes. मनोज समझ में आ गया? Yes. Okay. Illustration 15 homework. Yes. Okay. Repeat one more time. Okay. Fines account debit to outstanding fines. This is the accrued fines entry which is passed in the books. Okay. Tax base also same entry is passed because there is no information which is given cash, non-cash, etc. Nothing of that sort is there. But what is there is if you have not been given the payment, etc., then you also will be recording a similar entry in tax base, that is fines account debit to outstanding fines 100. But these outstanding fines will never have a deduction possible. Will never have a deduction that is possible. Why we won't have a deduction possible? Because it is a fine and you will never get a deduction of a fine. So that we will see that never get a deduction later in the future. वो अभी के लिए important नहीं है. For now, what is important is we are having. Is it okay? Yes. So though I pass this entry, expense not allowable in income tax. But that is a separate issue. That is a separate issue. Please set aside. Is it okay? Yes. Hence, tax base also is 100 only. Deductible, not deductible, we will see to that later. Have you understood? Yes? Okay, fine. Next, example 15, do it for homework. Okay? All right. Fine. I want you to read this for homework and solve these questions. 1, 2, 3. Example 17, 18, 19. Example 17, 18, 19. Okay? Yeah. Now, let us come back to that question. Let us come back to 1A. 1A required you to arrive at the current tax. Arrive at the current tax. Which we did arrive at. Which we did arrive at. So therefore, we got the current tax. And then we move on to the next example. That is 1B. Okay. Now, they are saying you determine the tax base. You determine the tax base. Okay? Alright. So, kar lenge. Yes, let us do the determination of the tax base. I can open this solution also. Okay. Question is there. You have the study module in front of you. You can just go on referring it. Okay. So now, based on the statement of financial position and notes from the previous example, calculate tax base of the assets and liabilities as of 31 March X8. Note that statement of financial statement position has been adjusted by current tax expense and liability. Okay. All right. Which is given in the next slide. Okay. Statement of financial position, etc., etc. Okay. So now let us come to our determination of tax base. Okay. Now, property, plant and equipment, you can see the information which is given. Cost of PPE 5.6 crores. H Limited deducted INR 1.456 crores in the tax returns prior to 7/8. Okay. So now, if I have to calculate the tax base of this, I will start with 5 crore 60 lakhs, less current depreciation, less previous year depreciation, giving you the closing tax base. So, 3 crore 42 lakh 30,000. Product development costs, product development costs, that's right. 35 lakh rupees. Okay. These costs were incurred as an asset amortized over 10 years. For tax purposes, H would deduct full product development costs when they were in X4, X5. Okay. So 35 lakhs. Okay. All right. So since these items were already expensed out earlier, it won't have a carrying amount now. So product development cost has a tax base of 0. Has a tax base of 0. Okay. Next, investment in subsidiary. Basically, I am moving from the asset side. Investment in subsidiaries 1.54 crores, no change in the value. So that also remains the same. Trading investments 72 lakh 80 is the carrying amount. Tax base is going to be, yeah, these investments are classified as at fair value and thus recognized in their fair value. Fair value adjustments are not being allowed by the tax authorities. Okay. So therefore, your inventory, your trading investments will be 80 lakh 50,000 only, the original cost, not 72 lakh 80,000. Next, you are having trade receivables. Okay. So trade receivables के case में, what is your opening value of provision? Yes. What is your carrying amount of provision? Okay. So this is the one. So let us look. Carrying amount 2 crore 19 lakh 10,000. Add back bad debt provision. So that gives you the cost 264 60,000. Okay. Next. Next. Add back. So this becomes my total provision, total debtor value. Debtor A 5 lakh 60 in first year, 8 lakh 40 already deducted for taxes, 14 lakhs. Debtor B only 1 year is deducted. Total deducted for tax purpose 17 lakh 50,000. Tax base of trade receivables is going to be total trade receivables minus deductible for tax purposes to arrive at 2 crore 47 lakh 10,000. Okay. So you can have a look at this. It's just a calculation. Okay. Next. H Limited created a provision for inventory obsolescence. This provision not tax deductible. So therefore, provision for inventory obsolescence, nothing is going to come because it's not permitted. Next, government grants are not taxable. Full government grant received in 7-8 is included in the statement of financial position. Okay. So I'm having my in the balance sheet, do I have government grant? Yes. 14 lakhs. Okay. Am I getting a gap in the inventory numbers? Yeah, that's right. Okay, fine. For income tax, provisions are not allowed, right? Provision is not tax deductible. So that is 6,30,000. So therefore, plus 6,30,000. So this comes to 112,70,000. Okay. Next, cash and cash equivalent, same. Deferred income, not taxable, 0. Warranty product cost, nothing. Trade payables, same. Healthcare benefits for employees, no impact because that is given in the question. Okay. Introduced healthcare. The expenses are allowable for only tax purposes when the benefits are paid, but not when you create a liability, and therefore it does not have a tax base. Therefore, it does not have a tax base. All right. So that takes care of all these items. So if I look at my balance sheet, okay. All right, this is okay. So these are my tax base items. Okay. We will proceed to the next example tomorrow on calculating the temporary differences. Have you understood the tax base workings here? See, some of it are computational. So just go through this particular thing for homework, trade receivables. Rest are all fine. Only the trade receivables you can have a look. Rest all are you clear with? Yes. Okay, fine. Shruti, did you follow beta? Kirti, did you follow? Shruti and Kirti, did you follow? Yadu confirmed. Oh, Manan is there. Okay. All right. Shruti, Manoj confirmed. Yukta, Kirti, Viraj, Shailesh. What about you guys? Did you follow? Okay. So this takes care of our tax base. Okay. All right. So step number 2 is complete. Step number 2 is complete. What is the tax base? That is essentially my value attributable for tax purposes to individual assets and liabilities. Okay, so you imagine as if you are preparing an income tax balance sheet, and basis that you will proceed to determine the tax base. Okay. Now the next one is computing temporary differences. Okay, the next one is computing temporary differences. And once you compute that, then we will look at what do we mean by taxable, what do we mean by deductible, and what are the meanings of timing differences, other differences, and when does it give rise to a DTA, DTL, and the accounting of that. Okay, so that takes care of this much. We'll catch up tomorrow morning again 7 a.m. Tomorrow the standard should get over. See, the presentation spans over more than 100 slides. Okay, but obviously I cannot complete 100 slides, but I'll be doing most of the part tomorrow. I'll be leaving you with some amount of homework, a fair amount of homework, because I would have explained all the concepts. So therefore, please go through that homework. Okay. So for now, it is done. See you guys tomorrow. Okay. See you guys tomorrow. Stay safe, take care, and come prepared for tomorrow's class. Come prepared for tomorrow's class. Is it okay? Yes. Thank you. Happy weekend. Weekend is still there for tomorrow. Yes. So see you guys. I hope the session has been useful. Yes. And let us meet tomorrow. Okay. Yes. Session done.